Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning on the show with us today, Etai Friedman. He's the manager of Ayala Capital Management, which is a family office based in California. Etai, welcome back to the program.
Thank you for having me. How you doing?
Well, I'm doing great, and I'm really excited to get you on. When we had you on last, I believe, in February, we were talking about a lot of issues in the global economy that could really bring things down. You were also relatively bullish on gold at the time, but the move had just started then, and it wasn't quite confirmed as to if we were in a new bull market for gold. I received a call from you last week, or I should say I called you last week, and you discussed a much higher interest level in the precious metals. Can you talk to us about what you're seeing in the space?
Yes, I actually repositioned my portfolio. I was long precious metals and short what I consider, or what I call, the public unicorns, companies like Amazon, Netflix, Tesla, companies that have multi-billion-dollar valuations but do not produce a dollar in free cash flow. Basically, business models that don't work but that exist due to the near zero interest rate environment that we're in. These companies finance their operations by selling debt or selling stock, not based on cash flow generation from the products or services they sell. So I was short a basket of these stocks, and I was long silver and gold. I had maybe silver and gold, maybe 25% of my portfolio, and last week I revamped my portfolio, and now it's 50% long silver, 25% long gold, and 25% cash. So I covered all of my equity shorts, and the reason I did that was because the stimulus or the monetary easing coming into the markets from the BOJ and the ECB is spilling over into the U.S. and taking down the 10-year Treasury, the 30-year Treasury, taking down our long-term interest rates. It's squashing equity volatility, and some of the things I was short. For instance, I was short a couple of REITs. Those are, dividend, relatively attractive dividend yielding products. And, of course, anything with any yield is attracting investors' interest. So until this central bank easing runs its course, I do not want to fight equities as they grind higher, as money flows into equities looking for better yields than negative yielding European and Japanese government bonds. That being said, there is to me a layup trade in the precious metals, which is why I'm 75% long gold and silver. And the reason is very simple. Every central bank on the planet is telegraphing to you that they have the intention of, at some point, destroying their currency and debasing their currency in the hopes of spurring economic growth by fostering debt creation. And we all know that that movie has played itself out several times in the last 20, 25 years and is not going to work this time. And so I envision basically a collapse in the world economy and a whiff of deflation, of real deflation, and then I expect the central banks, which are all uniformly run by Keynesian central bankers, I expect them to go into money printing overdrive, and I do expect high rates of inflation within the next 5 years. And there's going to be two things that are going to hold their value, maybe three. The two for sure are going to be gold and silver. Bitcoin is a wild card. I don't know enough about it to have an opinion, but it's certainly something that could possibly be a store of value, but I have no money invested in it. But gold and silver, basically the central bankers on the planet, all over the planet, are telling you to buy gold and silver. They've never telegraphed that message more clearly. And I'll give you an example. Did you catch the Swiss referendum that didn't pass last week or 2 weeks ago?
Well, I did, but why don't you outline briefly what the referendum was for our audience members?
Oh, this is priceless. I expected actually the Japanese to do this first. The Swiss National Bank, or the Swiss Treasury, had floated a referendum whereby they were going to give every Swiss citizen, regardless of income, regardless of wealth, they were going to give every Swiss citizen 2,500 Swiss francs to stimulate the economy. And anybody who knows anything about monetary policy and economics knows that you do not create wealth by printing money. If it were that easy, every central bank would just be printing endless amounts of money. When you print money like that and you hand it to consumers, what you're doing is you are effectively creating inflation. So if every Swiss citizen receives 2,500 francs, price levels in Switzerland would go up to adjust for the increase in money supply. But the referendum failed, but the fact that it even was floated and was even suggested tells you that what I'm expecting from these Keynesian central bankers is in effect going to happen. The referendum didn't pass because we're not in the middle of a financial crisis, but the next time this idea gets floated, and it'll probably happen in Japan, will be when everybody's in recession, and that referendum will pass that eventually, and that will create inflation, and gold and silver will explode. I mean, I think gold and silver are going to explode in anticipation of all of this money printing that's in the works. I mean, I'm not the only person who recognizes that every central banker on this planet is Keynesian, and Keynesians do not like deflation. They will not tolerate deflation. They will, however, tolerate inflation. And just knowing that simple fact and knowing that the world cannot take on more debt is basically the biggest green light to own silver and gold that I think has ever happened since the 70s. So if you're not long silver and gold in your portfolio, you are badly positioned. And if you're long a lot of financial assets like stocks and corporate bonds, the risk reward is so atrocious right now that the S&P may go to 2,200, and then after it goes to 2,200, it may go to 1,500, and then to 1,000, and then to 500, and gold and silver during that whole period will double, quadruple, quintuple, will go up to levels that nobody can possibly fathom at this point. I don't have price targets for gold and silver. My approach to knowing when I'll be ready to sell them is when we're in the midst of a financial apocalypse and deleveraging is going on a major scale, and paper assets have lost 2/3, 70 to 80% of their value. Then I'll be shifting money from precious metals into financial assets, but not before that point. So that is the mindset that I'm operating from.
Well, Etai, everything that you've just outlined is bullish for gold, exceedingly bullish for gold, but it leaves a big fat question mark for the U.S. equities. Today, we're recording this on Tuesday, July 12th. You've got the U.S. equities breaking out into all new time highs. And from a technical standpoint, after consolidating for over a year, for something to break out into new highs, it would seem like there's more upside ahead, which is just hard to fathom that these markets can keep going. So I guess you've removed your short positions on a lot of these stocks, but what's your feeling? What is going to cause the U.S. equities to come off? Gold obviously acts as a leading indicator of tumultuous times to come, so that tells us maybe something's finally brewing, but what's going to cause these things to drop?
We need to break the back of the equity bull market. We need a major financial calamity, and predicting what that's going to be for me is virtually impossible. You saw what happened when we had the Brexit. We had a seizure. That to me was the first act and the first scene of a long play. The next act to me probably will be Deutsche Bank becoming insolvent, but I expect that they're going to be bailed out, and I would be shocked if Deutsche Bank was allowed to fail, given that they have $1 trillion in assets, or $1 trillion in liabilities, and they're levered 30 to 1. I don't see how Deutsche Bank can be allowed to fail. But just the week that Deutsche Bank appears like it is going to fail, you will see the markets come undone, but they may quickly recover after a speedy bailout by the ECB or the German government. And we're going to have lots of events like Brexit, Deutsche Bank, going under. Things like this are going to start happening more and more and more, and we're not going to see them all coming. And then, of course, there's the whole issue of the world economy and where we're headed. And by any measure, global trade is still slowing, and the global economy is still grinding to a halt. And, how that manifests itself, I don't know. I don't know where it's going to show up first. I mean, China's in recession. The rest of the world is in denial about it. How it manifests itself, I can't tell you. But the Chinese are doing some rather insane things. They are probably on the path to hyperinflation because they don't know what to do with themselves. They don't know how to fix the credit bubble that they created that has already popped. They are trying to fix their credit bubble by printing more money, and it's pure insanity. But these things take time to work out, and the S&P 500 could go to 2,200 before anything material happens. And I'm not fighting that trend anymore. But at the same time, by any metric, U.S. stocks are the second most overvalued they've ever been in history. Whether you look at PE ratios, Tobin's Q, enterprise value to EBITDA, stocks are ludicrously priced. I mean, when you hear people talk about U.S. equities, you often hear them say that the S&P 500 is trading at 18 times earnings. That's 18 times pro forma earnings, which is nonsense, which is not real earnings. They're, in fact, trading at 24 times GAAP earnings, and that is the second highest they've ever been outside of the year 2000. So the risk-reward in equities makes no sense whatsoever. I mean, you can ride them up maybe for another 50, 100 points, maybe another 5-10%. But the downside you're looking at, I'm not kidding you. You know, I've said it before. I'll say it again. I think Tobin's Q will go to 0.3, and that would imply about an 80% drop in equities. It may take 3, 4, 5 years for that to happen, but it's going to happen, and equities are going to get absolutely devastated, and corporate bonds are also going to get devastated. And even government bonds, when the money printing goes into overdrive, there's going to be a huge reversal in government debt markets. We're going to go from negative yields and near zero yields to double-digit yields, and nobody is prepared for that. That is probably going to be the most devastating thing that will come to pass. But you don't have to worry yourself with all of that right now. You can sit on the sidelines, watch that, wait for it to unfold, and in the meantime, you can be invested in gold and silver, and I believe they're going to rally and continue rallying all through every stage of this process.
On the last interview we did together, you boldly predicted that interest rates in the United States would likely follow that of some European and Asian countries, potentially going into negative territory. Do you still believe that that is a possibility for U.S. Treasuries?
I do. I do think it's a possibility. I personally wouldn't be a buyer of treasuries at these levels, but it wouldn't shock me if the 30-year treasury went to 0.5% or 0%, or if we have negative interest rates in the U.S. The Fed is done raising interest rates. I mean, anybody who thinks that the Fed is going to raise rates is really disconnected from what's going on in the world. So the next move by the Fed is going to be an interest rate cut. But for them to do that, they have to basically swallow their pride and admit their mistake, their policy mistake, and that's going to take time. They're not going to do that overnight. So we're going to basically be the Fed funds rate is going to be unchanged for maybe 6 months or so. But I think by the first quarter of 2017, we're going to see a rate cut in the U.S. and then probably negative rates, and that may come to pass on the long end of the yield curve as well. There's really nothing stopping rates from going lower. There isn't at this point. What will end the government bond market rally will be the world sliding into recession, full-blown recession, because the recession will be extremely deflationary, and when that deflation, that whiff of strong deflation gets picked up on by the central banks, then it's all over. Then the money printing is just going to explode. We're going to have double-digit rates of inflation, maybe even hyperinflation. It's going to be insane.
Well, I agree with your thesis completely. In an era where we have high equity prices, high real estate prices, high prices for government bonds, gold is really one of the only, if not the only place to allocate capital. And couple that with a worldwide economy that holds well below 1% of their portfolio in precious metals or precious metals related equities, and you've got the perfect recipe for a very large move up. I want to end with a question on how you're deploying capital in the precious metals. You mentioned gold and silver, which makes me think that you're probably deploying directly into some type of ETF or physical metal. Are you buying the mining stocks as well?
You know, 6 months ago, I loved the miners. They were trading as if gold was 600 an ounce, and now they've obviously made a huge move. I don't like chasing them. If they pull back materially, I would probably add them to my portfolio. But at this moment in time, I prefer to own the actual commodities. You're correct. I'm doing it through ETFs. I'm not using futures contracts because the last I checked, for instance, the COMEX gold futures contract, there's not enough gold in the COMEX warehouses to back up all of the futures that are outstanding. So that's an example of a paper asset backed by a commodity that you do not want to own. But GLD and SLV are backed by commodities, by the appropriate amount of commodities. So I think they're going to hold their value and withstand any shock to the markets. So I'm 50% long SLV, 25% long GLD, and 25% cash. And I'm probably going to go to 100% precious metals, and I'll do that by doubling my GLD to 50%. That's probably going to happen over the next couple weeks. I mean, I've never seen a bigger green light for owning precious metals in my entire career, ever. I mean, I think gold and silver peaked in 2011. Last time on that last move up.
Correct.
We're gonna blow through those levels, and nobody's positioned for it.
All right. Well, Etai, thank you so much for coming back on the program. Always very insightful, and for me, a just great indicator that smart money like yourself is going from a very low, if any, holding in the precious metals to seeing this green light, as you've called it, to jump in, and in your case, 100% into the precious metals. That's just a huge endorsement for the sector, and I'm happy to have you join us on the belief in the precious metals sector. I think it's going to be a fun run. Etai, thanks for coming back on the program.
My pleasure. Thanks for having me.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?